While every Tom, Dick, and Harry knows that investing can change their lives for the better, not a lot of them know the power of small beginnings. Contrary to common belief, you don't need thousands of dollars to start investing. Far from that. You can kick off your investment journey with as little as $100. Still a bit skeptical? Don't be fooled by that capital. Just think of your $100 investment as a tiny seed. As little as it is, it still has the capability of growing into a giant tree. In today's video, we'll be going through super easy and practical methods on how you can start investing with $100 and make massive returns inspired by the teachings of one of the brightest minds in the world of investing, Charlie Munger himself. Have you ever wondered what makes Charlie Munger such a successful investor? Sure, he's a billionaire and the vice chairman of Berkshire Hathaway, but do you truly know his strategies? After spending hours dissecting Munger's investments over the years, there are three fascinating patterns and principles that we notice that happen to align perfectly with starting with little capital. And the first of these principles is to time your strike with perfection. Let's be honest, guys. Good opportunities hardly ever happen in quick concessions. They only happen rarely, sometimes just once. That's one of the reasons why, when it comes along, you have to take full advantage of it. Munger strongly advocates that this idea is applicable to investing as well. As an investor, always consider each day a wrapped gift that presents you with countless potential opportunities, but with a twist. To succeed in investing, you have to keep your mind sharp as you patiently observe the scenes. Have you ever seen a game of basketball or even golf? When the player wants to strike with his club or make an amazing three-point shot, he has to perfect his strike. Only when everything falls into place will they succeed. But guess what? This strategy perfectly aligns with investing. To strike gold, you've got to be patient enough to find that sweet spot. While we admit it can take months or years before that golden opportunity to astronomically grow your wealth arises, you must always be ready to make that perfect shot when the golden chance comes your way. To address this, always remember this timeless quote from Munger. The big money is not in the buying or selling, but in the waiting. With that out of the way, the second principle is to never underestimate inefficient markets. As you probably already know, Charlie Munger is one of the biggest figures in the world of investments. He is the vice chairman of Berkshire Hathaway, and as of the time of making this video, Berkshire has a market cap of $754 billion. According to Forbes, Berkshire is the 8th largest company in the world by market cap, and the biggest non-tech American company in the world. While Berkshire's substantial size might appear advantageous for many, Charlie and Warren consistently emphasize that the company's magnitude poses a hindrance to achieving high investment returns. You see, due to Berkshire's considerable financial scale, Charlie and Berkshire have their hands tied. They're constrained to concentrate solely on sizable investment prospects. The likelihood of these substantial opportunities being mispriced or inefficient in investing is exceptionally low. While big investors are often preoccupied with significant opportunities, they often overlook smaller prospects. And that's where your opportunity to strike comes in. Take a look at how Charlie Munger's Berkshire partner, Warren Buffett, perfectly explained this concept.
I was working with a tiny amount of money. And so I would pour through volumes of businesses, and I would find one or two that I could put $10,000 into or $15,000 into that were just ridiculous. They were ridiculously cheap.
Back when Warren and Charlie were dealing with modest sums years ago, they must have dedicated thousands of hours just to sift through extensive financial reports to uncover a single amazing potential. Fortunately for us all, the internet made it a lot easier to identify potentially mispriced stocks. With a simple visit to a stock screener, you can tweak the market cap range and PE ratio until you find amazing companies that will be considered too small by the lofty standards of Wall Street. Given how most professional investors refrain from investing in stocks below a certain market cap, they usually miss out on amazing potential investments. Compared to giant companies, no one pays heavy attention to the smaller ones, which increases the chances that you can find a stock trading well below its intrinsic value. And this leads us to the third investment principle, which we can learn from Charlie Munger, which is embracing a concentrated portfolio. While conventional wisdom advocates for highly diversified portfolios with dozens or even hundreds of stocks, Munger has a different perspective. When asked about his thoughts on diversified portfolios, he once said, "Diversification is a protection against ignorance. It makes very little sense for those who know what they're doing." As a matter of fact, he believes diversifying your portfolio if you want to make high investment returns is an insane idea.
One of the inane things that's taught in modern university education is that a vast diversification is absolutely mandatory in investing in common stocks. That is an insane idea. It's not that easy to have a vast plethora of.
Do you remember the common phrase of not putting all of your eggs into one basket? Well, that perfectly describes diversified portfolios. Concentrated ones are more different. Instead, it's all about purposely placing your eggs in fewer baskets that you believe have the highest potential and know intimately. Typically, a concentrated portfolio comprises a limited number of stocks, often ranging from 10 to 15 or even fewer. This investment strategy demands a profound understanding of each holding and its growth potential. Did you know Charlie Munger has allocated most of his family's net worth to just 3 investments? It's all in Berkshire Hathaway stock, Costco stock, and a fund managed by an investor named Lee Liu. Rather than endorsing diversification, Munger prefers to focus only on businesses he deeply understands. He believes that with careful examination and understanding of these businesses, he can make more grounded, informed decisions that could significantly increase the likelihood of attaining massive returns. Here's a clip of him talking about why he only invests in a concentrated portfolio.
I'm only interested in investing where I have some sort of advantage. And of course, that means I can't do the conventional things. And if I have the advantage in 3 different things.
How about we compare the difference between a diversified and a concentrated portfolio, and how the latter can be better using a real-life example of 2 investors, Mark and Caleb. You see, while Mark opted for a concentrated real estate portfolio, strategically acquiring properties in the thriving tech hub of Silicon Valley, Caleb decided to practice a diversified approach, spreading investments across various real estate markets, including suburban areas and tourist destinations. Over the years, as Silicon Valley experiences exponential growth and a surge in property values, Mark's concentrated portfolio benefits significantly. His properties in this tech-centric region appreciate exponentially, maximizing his returns. On the other hand, while Caleb's diversified portfolio minimizes risks, it also dilutes the potential for extraordinary gains. Some of his investments in slower-growing markets may not perform so well, offsetting the stellar performance of others. While both strategies aren't bad, the concentrated strategy works really well in this scenario. Can you see why Charlie Munger is simply a different kind of dynamite? Now that you have understood the rationale behind Charlie Munger's investment strategies, it's time to know the best moves you can make to make your $100 investments worth more in the future. Starting off, have you ever considered emergency funds? Investing that capital into building one can be a really prudent financial move. Just imagine it as a financial safety net. It will provide a sturdy buffer for unexpected expenses like medical emergencies or car repairs, shielding you from the burden of any unforeseen financial challenges. While this form of investment may not exactly be as flashy as some of the others we're going to discuss, make no mistake, it can be worth your while. Instead of risking the entirety of your capital in a potentially volatile investment, allocating it to an emergency fund ensures liquidity and quick access to cash when needed. It's like planting a financial seed that can grow into peace of mind, allowing you to weather unexpected storms without disrupting your long-term investments or accumulating high-interest debt. That said, while emergency funds are perfect for those who tend to be in a lot of emergency situations, things are largely different if that's not the case. If your financial emergencies are sorted, you will be in a much better position to start proper investments. If you prefer a hands-off, fully automated approach that demands minimal effort, a Robo Advisor could be precisely what you're seeking. Robo Advisors leverage apps or websites to understand your financial needs and devise an investing strategy tailored to meet them. They typically use fundamental details like age, family, size, income, and risk tolerance to customize a portfolio for you. Robo-advisors are fast becoming one of the most popular methods for making investments. They can take care of all the little details, from selecting investments to executing purchases and sales, while keeping you well informed throughout the process. And guess what? You could also use a micro-investing app, which allows investors to put small amounts of money to work over time. For example, a micro-investing app could enable you to round up your credit card purchases to the nearest dollar, investing your spare change. Moreover, it provides the flexibility to deposit additional funds, let's say an extra $100, whenever you have surplus money to invest. And speaking of investments, have you ever wondered how long it will take to build up your wealth to six figures as the years go by? Using an investment calculator, we can deduce how your future could be when you contribute $100 each month to an investment account. Imagine investing $100 with a 10% rate of return, reaching $100,000 in just 22.5 years. Doesn't that showcase the power of compounding? Now, consider a 6% rate of return, getting you there in 30 years. Wouldn't you say that's still impressive? Even at a more conservative 4%, you'd hit $100,000 in 37 years. It makes you wonder, what rate of return aligns with your long-term financial goals? And how about you? And this brings us to the point of high-yield savings account, an amazing choice for a lot of reasons. They offer a competitive interest rate compared to traditional savings accounts, ensuring that your money grows astronomically over time. Additionally, these accounts are typically low risk, protecting your initial investment and ensuring that your funds are easily accessible whenever you need them. And guess what? High-yield savings accounts are also a hassle-free option, requiring minimal effort to manage. You can watch your $100 incrementally grow with compound interest, offering a stress-free and reliable way to accumulate funds. That said, you may be required to put a minimum amount into your account or pay monthly or ATM fees, which can quickly eat into your savings. It's also worth noting that certificates of deposit may lock in your funds for a predetermined period, potentially incurring early withdrawal periods. Ensure that you won't require this money in the short term. Moving on, let's say the aforementioned options don't exactly sit right with you. Let's say you prefer the riskier aspects of investing. If you're like this, the stock market can be a good option, especially if you're looking to invest for several decades. With $100, you can invest in a concentrated stock portfolio as a strategic move for wealth creation. By doing smart research and picking the best companies in a specific area, you can capitalize on their growth and performance. As you probably already know, the stock market has historically shown an upward trajectory. Despite the fact that downturns happen from time to time, it hasn't failed in the long run. You might think $100 is little, but it's enough to buy a few shares of a company with a lower stock value or purchase fractional shares of high-revenue companies. The simplest method to acquire fractional shares is through a brokerage such as Stash, a micro-investing app that requires only $1 to begin. With access to hundreds of stocks and numerous ETFs, it provides a user-friendly way to invest in fractional shares. That said, have you ever wondered what Charlie Munger's ideal stock is? Take a look at his description.
We want to buy something that's intrinsically a very good business, meaning that an idiot could run it and it would do all right. And then we want that business, which an idiot could run successfully, to have a wonderful person in it running it.
It makes a lot of sense, right? That's precisely why he loves the Coca-Cola brand. When he was asked about picking one brand he'd have invested in if he could go back in time, here's what he had to say.
What would that company be today?
Coca-Cola.
Still?
If you take the amount of Coca-Cola drunk in the world and the main flavor, it's one hell of a brand.
His reason for picking Coca-Cola is simple. First off, it operates in the consumer goods sector, providing products with enduring demand. Secondly, it has a robust distribution network and effective marketing strategies. And don't get us started on the fact that Coca-Cola is a globally recognized brand with a long and stable history, reflected in consistent dividends. When picking stocks, you've got to consider things like that. It could be the deciding factor in how you change your financial story for the better. Before moving on from the juicy allure of stocks, investing in dividends is yet another amazing alternative. You'll receive a portion of profits relating to how many shares you own. While we admit you won't be getting mega payouts at first, you'll always end up making more money, especially if you compound your profits. And guess what? Many brokers offer automatic dividend reinvestment without charging you additional service fees. Some may even let you pick between full or partial enrollment. As long as you use your dividends to keep buying more shares, you can accelerate the speed in which you can build your portfolio. And how about startups? It perfectly captures the lesson from Charlie Munger on investing in small prospects. Just imagine you had invested $100 in Facebook before it became a mega company. Your investment would have been worth tens of thousands of dollars, if not more. Of course, investing in startups can be a risky endeavor. It could either grow to become a hit or crash and burn. Remember the principle of being patient and finding a sweet spot. Always take your time when doing your due diligence. That said, if the sound of investing in startups feels appealing to you, feel free to check out platforms like WeFunder and other equity crowdfunding sites to find startups that fit your investment interests. Some of these sites allow you to invest as little as $10 in a new company.